Good afternoon, everyone. My name is Khalil Jarrar. This session is recorded strictly for my class of International Finance and Taxation, so it's not intended for as a legal advice. Or if you do have specific issues, I always tell people please contact your tax advisor or your CPA, for that matter, to get more specific answers to your concerns. Anyway, today's topic is what's called a buy-sell agreement. What is a buy-sell agreement? Most people will take the term literally and say if somebody is buying something from someone else, then we have to devise what's called a buy-sell agreement, which is not the case here. It is very important to understand that when it comes to any legal matter, we have what's called legal terms of art. The legal term of art defines a specific application for a specific term. Since the topic is a buy-sell agreement, let's go ahead and dive into the definition, or what is called the is statement regarding a buy-sell agreement. And I'm going to read this verbatim, and I'm going to try to explain in details as we go, as we move forward. A buy-sell agreement is also called a buyout agreement. Normally, we have a specific entity, like a partnership or a closely held corporation, and the owners or the co-owners want to secure the interest of a partner or a co-owner if something wrong happens to that person. Normally, it's a key person in the partnership or the corporation, and they hold substantial assets. It's a binding agreement, as I said, between co-owners of a business that governs what happens if a co-owner dies or is otherwise forced to leave the business, or in other terms, incapacitated, which is basically an umbrella that hosts a lot of other meanings as well. It may be thought of as a sort of, and I like this definition, which is a premarital agreement for business or between business partners. It defines what you own. It defines what to expect after the incapacity or death of a partner. To give you a specific example that comes straight out of the one of the Markland cases, which is called the Knepp estate, or the estate of Knepp case. In that case, as I was reading the case, something just jumped at me. If you have a partnership and the partner dies, let's say it's just two people, A and B, hold the partnership. If one person dies, then number one, what happens to the partnership? Most entities, if it's just two-person entities, if one person dies, then that's an automatic dissolution of that entity. Especially when it comes to partnership, it does not survive the death of a person. So what happens? The co-owners say, okay, let's find a mechanism or an instrument that basically that instrument will be funded straight out of the business funds and will make the business as a beneficiary in case of death or incapacity of one of the partners. In the case of the partnership, which is basically, it's a family partnership, or what's called today, they have a specific entity which is a family limited liability partnership. One of the brothers dies, and he dies in December of 1948. What's the significance of a person dying in December? Well, if we were talking about a regular tax year, then that person would be taxable for the preceding year, to in accordance with their shares and what they could owe the government, which could be an easy solution. Now, most partnerships do not start, or most entities do not start on January 1st, or even anywhere close. It happens by the time you finish your paperwork and you fill out all the documentations needed, and you have your partnership agreement drafted by a competent person or specialist. Then it's probably February, March, or even May, or even middle of the year. It could be in July. So there's what's called a taxable year for partnership, or what's called a fiscal year, if you want to use a little bit more, advanced terms for the MBO holders out there. A taxable year or fiscal year, it means that we will be taxed from the beginning of the start of the entity till the year after that, and that would be our taxable year. In the case of these guys, the court basically pointed the obvious. Number one, how do we tax this entity? Number two, who do we tax? Do we tax the partner, or do we tax estate? How do we move this fund around? And how can be a business? And in this case, this gentleman had 10 different life insurance policies that's basically paid by the business, and the beneficiary is the business. And there was a question about who will hold this estate. Is it the successors and assigns, or the heirs of the estate, or is it the business? Also, the issues were raised from a tax perspective. The commissioner of that jurisdiction, when it comes to tax jurisdiction, wanted to hold basically do a double taxation, and question the fact that the business is the beneficiary, trying, basically asserting that having the business as a beneficiary, then we're trying to avoid paying specific taxes for that year if the shares of that person are transferred to his successors. Anyway, at the end, the outcome of the case, just to make it short and go back into what's a buy-sell agreement, the court found that the taxpayer's partnership terminated upon the partner's death, which we already discussed that, for tax purposes. Also, that partnership income prior to death should not be included in the partner's gross estate. We just covered that as well. And that the life insurance proceeds were also not part of the gross estate. That comes with that saying, because we said it doesn't go to the estate, the beneficiary is the business, or the successor in the business. Also, that the life insurance, we said, were not part of the gross defendant's partnership interest, and the partnership interest was reduced by his share of a partnership liability when he died. The person died in December. We go back and look, when was this entity started, what is the taxable year, and then we go from there. The only reason we're discussing the NIP estate is to go and look at, or for one reason, to look at what are the triggering events. After we have this binding agreement, it's a buy-sell agreement or it's a buyout agreement, we have what's called triggering events. We're going to go through each one of them and discuss it accordingly. Death or disability, we already mentioned that. Desire to sell interest to a third party, who would be that third party? Is there a matching offer? Everything that is discussed here is basically, we're talking about elements and stipulations in every carefully drafted agreement. A retirement of the owner. If the owner says, listen, I'm at a certain age, I don't want to continue with this business. I want to go back and rehash this. A partnership or a business entity, there's a substantial interest by some person. Normally, if this person leaves, one way or another, retirement, death, incapacity, or even the worst nightmare, if this person's estate do not agree on the continuation of the partnership or this entity, it means it will dismantle a huge part of this entity, and you'll be, and basically the situation will be chaotic, or you'll be scrambling to find someone else. So if you plan succession ahead with a buy-sell agreement, and I reiterate, most entities, or the entity in question for the estate of NIP, they chose to buy 10 or more or 11 life insurance policies paid by the business entity, and basically the business entity is the beneficiary. If I was the court, I would question, why would they buy 10 insurance policies to begin with? Not one that really covers all the areas. But I was not the judge. Good for the NIP family that I was not the judge for this case. So Plan ahead is one of the reasons we devise or we try to plan a carefully drafted buy-sell agreement. Um, Funny enough, to mention, one of the triggering events is the bankruptcy or divorce of a partner. So we understand the bankruptcy situation. Why would we want to ensure the succession of a partnership in case of divorce? That goes without saying as well. Normally, divorce is as disruptive for some people as death, or you could have a husband or a wife, it depends who your partner is, he or she, their spouse, maybe the reason for divorce was the business, and it's not going to be for the best interest of the business to go through the divorce event and find out what the other person, what kind of feelings they have towards the business. So try to plan ahead. Don't be what do you call it? Don't be a lame duck and wait for somebody to just come catch you or basically disrupt your business when it comes to a planning succession of your business or a partnership or any business entity for that matter. Another reason you have plans what's called cross purchase agreement. We'll go into details about this as well. And we have what's called the wait and see agreement. A wait and see agreement is a hybrid agreement that basically combines or attempts to give the entity and its owners maximum flexibility. I personally don't like the wait and see attitude. If I am planning or trying to devise an instrument for succession for any business, I will look carefully, study carefully, and don't leave any what do you call it, uncharted territories for contingencies. We always have to plan for contingencies, but leave contingencies for that. I would like to always cross the T's and make sure that we plan correctly for any succession. Most people walk into a lawyer's office or a business consultant, or it depends what part of the world you are in and who's allowed to do such planning. They try to use the default, and the default creates a default at the end, and that's what I firmly believe in. Having said that, a default creates a default. It means you walk in and you say, "Oh, everything is fine. We don't want to spend a lot of time and money on this agreement." And once things take a wrong turn, they'll be back in your office trying to what do you call it? Try to rectify and find ways out of that problem. So we have a business entity, specifically partnership. What impact would this have on a partner or the partnership in case of the death or incapacity of one of the major asset holders? We devise what's called a buy-sell agreement. One way to fund this is through a life insurance policy. Life insurance, when it comes to this specific deal, it's basically almost like a fund. It's like almost a saving account with a guaranteed payment to the partners or to the successors in interest. They have what's called. So how do we know we have an agreement today? We don't know when somebody dies. Excuse me. No one does. So that's why sometimes some estate planners go after life insurance policies, because it doesn't matter when somebody basically passes away or gets incapacitated. So there's a trigger or a mechanism of safety. I do not necessarily agree with that or basically endorse either or, as long as you have, if you have a solid plan to begin with. Now, let's go back to the buy-sell agreement and talk about, so establish a business today. What's the valuation method? How do we evaluate the interest of a person that we don't know when that person will basically leave or die? There are a lot of what's called, the valuation methods for such businesses. There's what's called the book value. The book value method, also known as the net asset value method, is based on the net worth, assets minus liabilities of a business or a company's book. Basically, this is an accounting